Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on Lesson 11.12 of Unit 11, Algorithmic Trading Fundamentals. In this lesson, we're going to cover 3 core ideas. First, what risk per trade automation actually means and why it matters. Second, why every trader needs a consistent way to size their positions. And third, how this automation fits into a broader risk management plan. By the end of this video, you will understand the basic concept of automating the amount of money you risk on each trade, see why consistency in position sizing is a game changer, and have a clear picture of the next steps you can take to start building that automation in your own platform. Think of it like setting a kitchen timer. You decide ahead of time how long to bake a cake, so you never overcook or undercook it. In trading, we set a risk timer that tells the computer exactly how much to risk, no matter which currency pair we trade. This takes the guesswork out of every trade and protects your account from accidental big losses. So let's dive in, break it down step by step, and get you comfortable with risk per trade automation. Let's start by defining risk per trade automation in the simplest possible way. Risk per trade is the amount of money you're willing to lose if a trade goes against you. Automation means you tell your trading platform to calculate that amount for you every time, instead of doing the math manually. Imagine you are budgeting for groceries. You decide you will never spend more than $50 on a single shopping trip. You write that rule down, and each time you go to the store, you simply check the receipt to see if you stayed under $50. In trading, the receipt is your stop-loss distance, the number of pips between your entry price and the price where you will exit if the market moves unfavorably. The platform takes that distance, multiplies it by the amount you decided to risk, and instantly tells you how many lots, the trading unit, you should buy or sell. This is important because it removes human error. You won't accidentally type in the wrong number of lots and blow a hole in your account. It also ensures that every trade, whether it's a tiny euro to US dollar move or a big pound sterling to Japanese yen swing, carries the same monetary risk. Consistency is the cornerstone of long-term success, and automation is the tool that guarantees that consistency, even when you're sleepy, distracted, or trading multiple pairs at once. By automating risk per trade, you protect your capital and keep your emotions out of the equation. Now that we know what risk per trade automation does, let's talk about why traders need consistent position sizing. Position sizing is simply how many lots or units you trade in each operation. Consistency means that each trade risks the same dollar amount, regardless of the currency pair or market conditions. Think of it like driving a car. You set your cruise control to 60 miles per hour so you maintain a steady speed. If you constantly change the speed, you would waste fuel and increase the chance of an accident. In trading, if you randomly change the size of your positions, you might risk $10 on one trade and $1,000 on the next, which can quickly erode your account when a few big losses hit. Consistent sizing keeps your overall risk level stable, making it easier to predict how your account will grow or shrink over time. It also helps you stay disciplined because you're following a rule rather than reacting to excitement or fear. When you combine consistent sizing with automation, the computer does the math for you, ensuring that a 50 pip stop on euro to US dollar always translates to, say, a $100 risk, while a 30 pip stop on pound sterling to Japanese yen also results in the same $100 risk, just with a different lot size. This uniform approach protects you from the temptation to go big after a winning streak, and it smooths out the ups and downs of your equity curve, making your trading journey more sustainable and less stressful. All right, looters, let's walk through a concrete example that you could actually place on a live chart. Imagine we're looking at the euro to US dollar pair, which tells us how many US dollars 1 euro can buy. On the chart, we see the price hovering around 1.1050, and we notice a small bullish candle, meaning the price moved up a bit during that hour. That candle becomes our potential entry point. We decide to buy or go long at 1.1050 because we think the euro will keep climbing. Now, no trade is safe without a safety net, so we set a stop loss just below the recent low at 1.1020. The distance between our entry and stop loss is 30 pips. A pip is the smallest price movement in most Forex pairs. Here, 1 pip equals 0.0001. So 30 pips equals 0.0030 in price. Next, we decide how much profit we want to aim for. A common approach is to set a take-profit level that is a bit larger than the stop-loss distance, giving us a risk-to-reward ratio of about 1 to 1.7. So we place our take-profit at 1.1100, which is 50 pips above the entry. This means if the trade works, we could earn 50 pips, but if it goes against us, we limit loss to 30 pips. By visualizing entry, stop-loss, and take-profit on the chart, we instantly see the trade's risk and reward. This simple setup forms the backbone of disciplined trading because every trade now has a clear plan for where we get in, where we get out if things turn sour, and where we aim to collect profit. Remember, the numbers can change for any pair, but the idea stays the same. Define entry, protect yourself with a stop-loss, and set a realistic profit target before you press the buy button. Now that we have our entry and stop-loss levels, we need to translate that price distance into a real dollar amount we are willing to lose. This step is called calculating dollar risk, and it's crucial because it tells us exactly how much of our account we are putting on the line. Let's say your trading account holds $10,000. A common rule for beginners is to risk no more than 2% of your account on any single trade. 2% of $10,000 equals $200, so that becomes our maximum dollar risk for this trade. Next, we look at the stop-loss distance we set earlier, 30 pips. A pip, as we mentioned, is the smallest price move. Here it's 0.0001 in the euro to US dollar quote. To find out how much each pip is worth in dollars, we use the formula pip value equals dollar risk divided by stop-loss pips. Plugging in our numbers, pip value equals $200 divided by 30 pips, which equals about $6.67 per pip. However, most platforms calculate pip value based on lot size, so we'll reverse the process later. For now, we know that if the price moves against us by 1 pip, we would lose $6.67. And if it moves 30 pips to our stop-loss, we lose the full $200. This calculation also helps us see the relationship between the size of our stop-loss and the amount of money we're risking. If you decide to use a tighter stop-loss, say 15 pips, the same $200 risk would require a higher pip value, meaning you need to trade a larger position. Conversely, a wider stop-loss would need a smaller position. By always converting the pip distance into a dollar amount before you trade, you keep your risk consistent, no matter how volatile the market gets. This disciplined approach protects your account from large, unexpected losses and builds confidence in your trading plan. We have our dollar risk of $200, and we know the stop-loss is 30 pips away, but we still need to figure out how many lots to trade so that a 30-pip move equals exactly $200. In Forex, a lot is a unit of measurement for the size of a trade. A standard lot equals 100,000 units of the base currency, in our case, euros. A micro lot is 1,000 units, and a mini lot is 10,000 units. The pip value changes with the lot size. One standard lot of euro to US dollar moves about $10 per pip. A mini lot moves $1 per pip, and a micro lot moves 10 cents per pip. To automate the conversion, we use a simple formula. Lot size equals desired dollar risk divided by pips to risk times pip value per micro lot. From the previous scene, we calculated a pip value of 10 cents when using a micro lot. Plugging in our numbers, lot size equals $200 divided by 30 pips times 10 cents equals $200 divided by $3 equals 66.67 microlots. Since one microlot is 0.01 of standard lot, that equals 0.6667 standard lots. In most trading platforms, you can enter this as 0.67 lots, and the platform will round to the nearest allowable size. Many platforms also let you set up a risk per trade calculator. You input your account balance, the percent you want to risk, the stop-loss distance in pips, and the system automatically outputs the lot size. This automation removes the need to do manual math each time you trade, ensuring you always stay within your risk limits. To enable it, You usually go to the Position Sizing or Risk Management tab, select Risk per Trade, enter 2%, and link it to your stop-loss level. The software will then adjust the lot size for any new trade you open. By letting the platform handle the conversion, you avoid calculation errors, keep your risk consistent across different pairs and account sizes, and free up mental bandwidth to focus on market analysis. Remember to double-check the calculated lot size before you hit the order button, especially if you switch to a different currency pair where pip values differ. Now let's watch how risk per trade automation actually works inside a trading platform. Imagine you are about to place a trade on the euro to US dollar pair, and you have decided that you never want to lose more than 1% of your account on any single trade. In our example, the account balance is $10,000, so 1% equals $100. The automation tool we are looking at has 3 input boxes: the total account balance, the dollar amount you are willing to risk, and the distance you plan to set your stop loss in pips. A pip is simply the smallest price move in most currency pairs, like 1/100th of a cent for euro to US dollar. You type in a stop loss distance of 50 pips, which is a common modest distance for a short-term swing. The script then does the math for you. It converts the dollar risk into a position size, or lot size, that will cause a loss of exactly $100 if the market moves against you by 50 pips. In this case, the calculation returns a lot size of 0.20, which the platform displays in bright green to show it is ready to use. When you click the Apply button, the platform automatically fills the order ticket with the correct lot size, so you never have to guess or manually calculate. This eliminates human error, speeds up trade entry, and ensures that each trade follows the same risk rule, no matter how busy the market gets. The visual on the screen reinforces the concept. The stop-loss line on the chart is marked in red, the risk amount in white, and the resulting lot size in green, making it clear how the numbers connect. By using this automation, you turn a potentially confusing calculation into a single button press, keeping your risk consistent and your mind focused on market analysis rather than arithmetic. One of the most common slip ups for beginners is forgetting which currency your account actually uses. Let's break that down with a simple kitchen analogy. Imagine you are cooking a recipe that calls for 2 cups of flour, but your measuring cup is marked in milliliters. If you ignore the unit conversion, you will end up with the wrong amount of flour and the dish will not turn out as expected. In Forex, the unit you need to watch is the account currency, the money you deposited with your broker. If your account is denominated in British pounds, but you're trading the euro to US dollar pair, the profit and loss from that trade will be calculated in US dollars, not pounds. The risk per trade calculator we saw earlier assumes the risk amount is expressed in the same currency as the trade. So if you type in a risk of $100 while your account actually holds pounds, the platform will incorrectly size your position. For example, with a 10,000 pound account, a 1% risk is 100 pounds, which is roughly 123 US dollars at a typical exchange rate of 1.23. If you tell the automation to risk $100 instead, the script will produce a smaller lot size, perhaps 0.13 instead of the correct 0.20, because it thinks you are willing to lose less money than you truly are. This mismatch can either overprotect you, reducing potential profit, or underprotect you, exposing you to larger losses than intended. The diagram on screen shows a correct calculation on the top row in green and a mistaken conversion on the bottom row in red, with a warning triangle highlighting the error. To avoid this, always double-check that the risk amount you enter matches your account's currency, or use a conversion tool to translate pounds to dollars before feeding the number into the automation. Consistency in units is as essential as consistency in risk percentage, and it keeps your trading plan reliable. The final beginner pitfall we need to discuss is the tendency to ignore spread and slippage when calculating risk. Think of spread as the small gap between the price at which you can buy and the price at which you can sell, similar to the difference between the listed price of an item in a store and the price you actually pay after tax. In Forex, the spread for a pair like euro to US dollar might be 2 pips, meaning the best ask price you can buy at is 1.2002, while the best bid price you can sell at is 1.2000. If you place a market order to buy at the ask, you immediately start the trade 2 pips away from the midpoint, which already reduces the distance to your stop loss. In our example, you intend to enter at 1.2000 and set a stop loss at 1.1980, a 20-pip buffer. However, because of the 2-pip spread, your actual entry price becomes 1.2002, shrinking the effective stop-loss distance to 18 pips. Slippage adds another layer of uncertainty. Slippage occurs when a market moves between the moment you click buy and the moment the order is actually filled, often during fast-moving news or low liquidity. If the price jumps an extra pip upward before your order fills, you might end up entering at 1.2003, further reducing your buffer to 17 pips. The chart on screen shows the intended entry and stop-loss lines, the spread as a thin red shaded band, and a dashed orange line illustrating a 1-pip slippage that pushes the stop-loss closer. This visual helps you see that the theoretical risk of 20 pips becomes a smaller, less safe number once you factor in real-world trading costs. To protect yourself, always add a few extra pips to your stop-loss distance to account for spread and possible slippage, or use limit orders that specify the exact price you are willing to accept. By building this buffer into your risk per trade calculation, you keep the actual dollar risk close to what you intended, even when the market adds its own little surprises. All right, looters, let's walk through the exact steps to set up risk per trade automation, and I promise we'll keep it as simple as programming a coffee maker. First, open your trading platform and locate the Settings or Preferences menu. Think of this as the control panel of a car where you set the speed limits. Click on the Risk Management tab. You'll see a clean dark screen with white labels. The first field asks for your account currency. This is the money your broker shows in your balance, for example, US dollars. If your account is in dollars, type USD. This step prevents the common mistake of mixing currencies later on. Next, you'll find a box titled Risk Percent per Trade. Here you decide what slice of your account you are willing to lose on any single trade. A good starting point for beginners is 1%. So you would type 1 into the box. The platform will then ask for your stop loss, pips. A pip is the smallest price move in a currency pair, like a single step on a ladder. Suppose you plan to place a stop loss 50 pips away from your entry. Type 50. Now hit the green Calculate Lot Size button. The system instantly converts your 1% risk, the 50-pip distance, and the USD account into a lot size, perhaps 0.02 standard lots for a Euro to US dollar trade. A small red warning may appear if the calculation exceeds your margin. You can adjust the risk percent or stop-loss distance accordingly. Finally, click Save or Apply to lock the rule. From now on, every time you open a new position, the platform will automatically size the trade to match your predefined risk, just like a thermostat keeps the temperature steady. Remember to double-check each field before saving, because automation only works as well as the numbers you feed it. With this setup, you eliminate guesswork and ensure consistent position sizing, which is the foundation of disciplined trading. Now that your automation rule is saved, it's time to test it, and the safest way to do that is with a demo account. Think of it as a video game where you can practice without risking real money. First, open a demo account provided by your broker. It mirrors a real trading environment, but uses virtual dollars. Deposit, say, $5,000 virtual cash. This amount will act as your practice bankroll. Next, pull up the Euro to US dollar chart, which we'll use for our example. Suppose you see a clear bullish signal. The price has just bounced off a support level at 1.0800 and is heading upward. You decide to enter a long trade at 1.0820 with a stop loss 40 pips below at 1.0780 and a take profit 80 pips above at 1.0900. When you click Buy, the platform's automation instantly calculates the lot size based on the 1% risk rule you set earlier. In this case, a 40-pip stop loss on a $5,000 account at 1% risk equals $50 risk. The platform converts that into a lot size of roughly 0.03 standard lots, and you'll see that number appear in the order confirmation. This automatic sizing removes any manual math and ensures you never exceed your risk limit. After the trade is placed, watch the demo account summary table update in real time. It will show the lot size, the dollar risk, and the current status of the trade. If the market moves favorably, the trade will hit the take profit line and the table will record a profit. If it hits the stop loss, the loss will be exactly $50, no more, no less. Run several trades this way, adjusting entry points, stop loss distances, and risk percentages. Pay attention to how the automation reacts when you change the stop loss distance. A wider stop will automatically reduce the lot size to keep the dollar risk constant. This testing phase is crucial because it shows you that the rule works consistently, even when market conditions shift. It also helps you become comfortable with the platform's interface, so when you switch to a live account, you'll know exactly what to expect. Remember, the goal of demo testing is not just to see green numbers, but to verify that the automation respects your risk parameters in every scenario. We've seen how to set up and test a risk per trade automation rule, but the real power comes when you connect that rule to your broader risk management plan. Think of it like linking individual bricks to build a sturdy wall. The first brick is the automated lot size we just created. Each trade now carries a fixed dollar risk, for example, $50 per trade. The next layer is your daily loss limit, a ceiling that says, I will not lose more than 2% of my account in a single day. On a $5,000 account, 2% equals $100. By adding up the dollar risk of every open or closed trade throughout the day, the platform can automatically stop you from opening new positions once the $100 threshold is reached. Some brokers even let you set this as a hard stop in the settings, so the system blocks additional orders. The third layer is the maximum drawdown, which is the total amount you are willing to lose before you pause trading entirely, perhaps 10% of your account, or $500. This figure is tracked over weeks or months, not just daily, and helps you avoid a cascade of small losses turning into a big one. When you combine these three elements, per trade risk, daily loss limit, and overall drawdown, you create a safety net that works automatically, just like seat belts and airbags protect you in a car. In practice, after each trade, the platform logs the risk amount, updates the daily exposure total, and checks it against your predefined limits. If the daily limit is hit, a red warning appears and the new order button is disabled until the next trading day. If your cumulative loss approaches the drawdown ceiling, you receive a stronger alert, prompting you to review your strategy before proceeding. By linking the automation to these higher-level controls, you ensure that even on a losing streak, your account never erodes beyond what you are comfortable with. This disciplined approach removes emotional decision-making because the system enforces the rules for you. So, always set your per trade risk first, then define a daily loss cap, and finally establish a maximum drawdown. Keep these limits realistic. Start small, like 1% per trade, 2% daily, and 10% overall, and adjust as your account grows. With this hierarchy in place, you are building a robust risk management framework that protects your capital while allowing you to trade confidently. That is everything for Lesson 11.12. Risk per trade automation. If this helped you, smash that like button and subscribe to Tick to Loot so you never miss a lesson. Drop a comment below. What was the most useful thing you learned today? See you in the next lesson, looters. Keep turning those ticks into treasure. Before we wrap up, let me remind you why this outro matters. Think of the like button as a high five to the community. Each tap tells the YouTube algorithm that our content is valuable, which in turn brings more fresh learners like you into our circle. Subscribing is like signing up for a daily newsletter, but in video form. It guarantees you'll be the first to hear about new tools, shortcuts, and real-world examples that turn theory into profit. When you comment, you're not just talking to me, you're sparking a conversation with fellow looters who might have faced the same challenge you're tackling right now. Those shared insights often become the missing piece in a beginner's puzzle. Remember, the journey from a curious viewer to a confident trader is built on small, consistent actions. Watching the video, practicing the steps, and engaging with the community. Each of those steps reinforces your learning and helps you stay accountable. So go ahead, click that like, hit subscribe, and type a quick note about today's most useful tip. Maybe it was the way we turned a dollar risk into a precise lot size, or the reminder to always check your account currency before automating. Your feedback fuels future lessons, and together we'll keep sharpening our trading edge. Thanks again for being part of the Tick to Loot family. Stay disciplined, stay curious, and, as always, keep turning those ticks into treasure.